In market news now, the JSE was weaker this morning while global markets were mixed as investors focused on the lack of progress, the US debt ceiling talks, as well as the heightening fears of a default. Locally, attention is on the Reserve Bank's Monetary Policy Committee, which is scheduled to announce its decision on the interest rates this afternoon. In company news, retailer Lewis Group believes that the tough retail conditions will continue to deteriorate as high inflation, interest rate hikes, greater transport costs, and increasing food and energy prices squeeze consumers' disposable income. As a result, it expects the appetite for credit to continue as customers feel the pinch. And we also looked at the rand, which was weaker in early trade as investors again are concerned about those US debt ceiling talks, and that has boosted the dollar and hurt riskier assets. Ahead of the decision, we'll be taking a look at the local bond market. We're going to have that conversation with James Turp, who is a fixed income portfolio manager at Sanlam Investments. James, thank you so much for your time this afternoon. Let's start off by looking at the sentiment in the fixed income space, and I suppose as well the kind of appetite you're seeing when it comes to South African bonds.
Thanks for having me, Nastasha. So it's kind of a tale of two halves in the bond market this year. You've got foreign selling coming through to the tune of about 110 billion now year to date. So foreigners seemingly lightening up on South Africa and global risk assets, whereas you've had that slack being taken up by domestic investors such as asset managers like ourselves, who are seeing value selectively on the bond curve. So the global story with all the uncertainty has been to reduce risk until the US gets out of its hiking cycle. Then hopefully that sort of appetite will turn, and that's what's evident with that large amount of foreign selling we've seen this year.
Right. In this environment of high inflation, I suppose both locally and abroad, what has that meant for yields, at least over the past few months?
Yeah, I mean, we've been doing some research on how interest rates and inflation just took the market by surprise. And it was totally unexpected that rates would be accelerated as high to control that rampant inflation like it's been doing. And so, of course, as inflation rose, bond yields had to rise as well. But now we expect the inflation profile, thanks to base effects, to drop away quite sharply over the next couple of months. So when we look at real rates, which is, of course, what you earn after inflation, with inflation expected to fall anywhere to around from 6.8 yesterday down to around 5%, that is going to make our domestic yields look more appealing too. So the long and the short of it is that we've had higher yields thanks to inflation. We've had higher yields thanks to increased risk premia. And as a result, when inflation does turn and looks like it's going to stay lower, these bonds surely will be more appealing.
Your assessment of the rand's performance since the beginning of the year and what that means for the Reserve Bank this afternoon, because we're still in two minds about whether we're going to see 25 basis points or 50 basis points.
Yeah, so that's the big unknown, isn't it? So it's almost like the Reserve Bank kind of changed the rules a little bit in the March MPC by surprising everyone with that 50 basis point hike. Now, here's the interesting thing. The rand going into the March MPC was only weaker by about 4.5% to the dollar for the year. After that 50 basis point hike, the rand has weakened about 9.5%. Of course, we've had the political news that came out with regards to Russia and how that seemingly accelerated the rand's deterioration. The rand's not on its own, but it is the worst performing currency for the year. But interestingly, I think the point is that higher amount of interest rate increases, which the Reserve Bank, by its own admission, can do very little for the sources of our inflation, but for expectations and for the imported inflation via the rand. And it had the opposite effect. It's almost, in some ways, the market interpreting it to be at a tipping point where these incremental hikes actually start damaging what little growth remains in the economy. And perhaps that is why the rand weakened after that. Counterintuitively, you would expect a higher interest rate to create a better carry and a more stable currency, but something has changed since that surprise hike in March, which makes today's meeting even more fascinating to see how it plays out.
On that note, then, if you had to give them a piece of advice, what would you say they do, 25 or 50?
So I've been telling everyone I'm a little gun shy because in the March MPC, I said that they should do 25 or 0 in my opinion, because those cumulative hikes will take their effect and have bought them sufficient time to wait and see incoming data. But of course, that rand weakness and the expectations going higher has changed their view on that. But I would still stick to that position at the moment. And I think a sensible call from the Reserve Bank today would be 25. So sound like you're still vigilant, of course, as they are about inflation, but I think they can afford to do a little bit less. Now, we must remember the market is fully discounting just over 50 basis points. So the consensus is for 50. So I think it would be interesting to see a hawkish message, a 25 basis point increase. I think you might just see the rand strengthen against the dollar off the back of that.
All right, let's take things stateside, and you look at the Fed, and a lot of analysts have been saying there is a long road between a pause and a cut going into the June meeting. What are your expectations?
So we've done some research on this, the altitude of the peak of a rate cycle and how long it lasts in America. And if you go back, because their data can go back quite far, so we've looked at it between sort of 1971 and 1993. The average time that rates peaked was only 2 months. So they would hike rates and then 2 months later start cutting them again. Of course, more recently, from about 93 to now, the average in America is 9 months that rates stay at the top. So what they're looking at now, if you look at what their futures are pricing in, they're saying there's a little chance of a hike over the next 2 meetings, but by the end of the year, we'll be 25 basis points lower than where we are now. So that kind of gives you, it's roughly around that sort of 7, 8 month period, isn't it? So that's what the market's saying. And it's been a lot lower. The market only about a month ago was expecting rates to be as much as 1% lower by the end of the year. Of course, that was around the time of the banking crisis and all the news around Silicon Valley and other regional banks.
Right.
So this is a highly liquid developing picture.
James, I would have loved to have a conversation with you about the type of trading opportunities you see in this particular environment, but we'll leave that conversation for another time. That is James Terp, who is a fixed income portfolio manager at Sanlam Investments. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you. Stay tuned.